All right, guys, it's 7 Central anyway, so I wanted to thank everyone for joining the webinar. We're going to try to start right on time. We know people's time is valuable. I'm Mark Kenny. Some of you know me already, some of you might not, but I'm with Nighthawk Equity. Michael Blanc actually cannot join tonight. He's in Dubai, so he wasn't able to join the call. But Drew and Philippe are on the call as well. Make sure, Drew, can you hear me okay, by the way? Make sure you can hear me okay.
Yep,
cool.
I can hear you.
Perfect. And we wanted to go over this opportunity in Memphis. This is our 5th property in Memphis. Both Philippe and Drew also own in Memphis. Philippe was on our last deal, if you remember, where we had 2 properties that we bought in Memphis as well. Drew's going to go through the property in more detail. Philippe's going to jump in as well, but as far as an overall perspective, I just want to level set. People kind of ask me what I like about this deal in particular. One, it's a decent size. It's 168 units. It's, price-wise, 4.2 million, which is $25,000 a door, and it's already been pretty much fully rehabbed. So that's a very, very positive thing, and it's going to cash flow pretty much day one right out of the gate. So with very little to no deferred maintenance. So a lot of things I like about it. Drew's going to go through in more detail, and then we'll open it up at the end for Q&A, and we'll answer any questions we possibly can. If for some reason we don't know the answer, we'll get it for you and distribute that answer out to the group as well. But again, thanks for joining. I'm going to turn it over to Drew.
Okay. Thanks so much, Mark. Thanks, everyone, for joining on the call. I'll just go through the property in more detail. So I'm going to share my screen right now. We can dive right in. Dogwood Trace Apartments, as Mark said, is in Memphis, 168 units, and we have it under contract at $4.2 million. The property is very nice. It's the prior owner, the current owner of the property, purchased it and has put in over $1 million in renovation to the property. So everything from the interior to the exterior has had some significant investment on it, and we're buying it pretty much a turnkey position. That structure has allowed us to lock in some really good financing terms. That's one of the things that we like about it. We have a mortgage at an 80% loan to value at 4.48%. And this rate was locked into before the recent jump in interest rates. And so the fact that we have inexpensive money with strong leverage is one of the many things we like about the deal. There are many other things we like about the deal as well. I'm going to go through a couple right here. High occupancy. It's currently sitting at 95% occupied. And so that's a tremendous occupancy for this market. And our property manager doesn't see any reason why that should change. We also have a very clear line of sight to increasing rents on the property. They're currently about $70 below where we think we can have them in 3 years. And that's through either raising rents and bringing all of the rents up to market levels. I'm going to have Philippe share a little bit more about another aspect of the property that we like a lot, and that's called the pilot program. And that's something that is a unique program that the city of Memphis has. I'll let Philippe share more at this point with it.
Yeah, so the pilot program is a tax incentive program that was set up by the city of Memphis, and basically in exchange of a developer, an investor investing $1 million in a property and giving benefits of this investment to the tenants, they will freeze the taxes for 10 years. And so that's what the current owner did 2.5 years ago. And this program can be transmitted to the next owner, so that will benefit of 7.5 years of this program of reduced taxes until we dispose of the property. And That's
Yeah,
it.
one quick thing on that, just to comment on that as well. Yes, they freeze the property taxes for 10 years, but they also cut them in half.
That's right.
So the property taxes are 50% what they normally be, then frozen for 10 years, and that's a very strong position from an expense perspective. So that's something to note.
Absolutely.
Yep.
Yeah. So here's just another good photograph of the property from a whole. Is 11 two-story buildings over about 9 acres in southern Memphis. And we also have a neat video that I'm going to share with you about the property. So I'll pull it on right here. So one of the things that we really like about this building is that it's bright. You can see in that video that the units are well taken care of. It looks attractive. All the units have sliding doors to let in plenty of light. So it's a nice, attractive property. It's also gated and secured, and there's one entrance in and out of it, which gives the tenants a strong sense of security on the property. So there's a lot of nice things about it. The property is equally divided into 2-bedroom and 1-bedroom units. And so here's an aerial view of the units. And one amazing thing about it, when we did a comparable rent survey of similar properties in Memphis, is that the square footage is larger than other 1-bedroom and 2-bedroom units in the area, but the rents are less than those smaller properties. So the rents, this is sort of further evidence that the rents have room to move upward. Here's some more photographs of the units. You can see, as we said, that almost all of the units have been turned. There's 9 units of the 168 that have not been fully renovated. And the only reason that those units have not been renovated is because they're long-term tenants who have paid on time and have not shown an interest in leaving. So when those tenants do leave, we will renovate those as well. But otherwise, the remaining basically 160 units have all been turned and are in really attractive, good shape. Here are a few more photographs of the property. So then I wanted to dive next into the financial returns on the property. We expect to hold the property for 5 years. And during that time, we expect the average cash-on-cash return to be 11.5% and a total return to the investors of 90%. We're confident in these returns despite using conservative underwriting conventions. So a few of those that I'm going to highlight here is that as far as rents go, as of January, the average rents for the 1-bedrooms are $430. But the most recent units that we've rented out on the 1-bedrooms are $475. So there's already a gap there of $45 between the average and the most recent rents. And then the same thing goes for the 2-bedrooms. The 2-bedrooms, the average rents there are $530. But the most recent units have rented out for $575. So again, you have that $45 gap there that we can close. And our property manager, who we already are working with on a 321 unit in Memphis, is confident that there's room for it to go up another $25. So from $475 up to $500, or from $575 up to $600 in the short term. So we believe that we can increase rents of $70 in the short term to bring these rents up to market. Secondly, when we do underwriting on this deal, we put in a replacement reserve of $250 per unit before we get to our NOI line. And some people, when they analyze deals, will put that after NOI, but our NOI numbers, which ultimately affect the exit price that we believe we can sell it at, are baked into our numbers, what we call above the line. And then third, our real estate taxes that we've put into the model are higher than what we will actually pay on the pilot program. So as Mark said before, our real estate taxes are locked at about $22,000 every single year for the next 7.5 years on this property. But even though they're locked at that number, we've scaled them up from 22 to 28 to 35 along those lines over the course of the ownership to be conservative. So in fact, the cash flows should probably come in higher than that 11.5, but we've staged up those taxes just to be careful on our underwriting. So you can see a bit more of the numbers here in this table. I won't go through it, but I just wanted to highlight for you the way that we think about and the way we underwrite these deals.
One quick comment on that. So we did that underwriting, which Drew will show you with the taxes going up, but that is cash that we actually will have available to distribute. And there is no risk or issues with the city coming back and saying, oh, okay, that you're off the pilot program. So just to be clear, we did that more for our internal purposes, but that's the way we showed it. The cash and cash would go up as a result of that. And we show in the table how we increased that, and Drew will show you that as well.
Yeah, so at this point, I wanted Philippe to go over a little bit more of the background, the overall Memphis market, and why we don't just like the Dogwood Trace property, but the market as a whole.
So actually, we'll start by looking close to the property, and then we'll look at a bigger picture over the next slide. And so this. Oh, no, you please. I think you went, okay, market summary, thank you. So the property is near the airport, it's about 5 miles from the airport. And as probably most of you know, Memphis is the headquarters and the main hub of FedEx. And actually, if you look at the list of employers nearby, you have 15,000 employees at the FedEx Super Hub. And that's basically, if you're using FedEx, there's a very, very high chance that your packages will transit through Memphis. And again, 15,000 employees. Also near the airport has a very, very high concentration of distribution storage area. And a lot of people are working in this near the airport in distributions in general. So if we go actually to the next page, what's also noticeable is Memphis. To look at a larger picture is rather from the airport zooming out. You have also rail that is a very high component, and trucking that is very high component. So Memphis is really a key place for a lot of the logistics in the country. And there are some rankings there. You have third in terms of rail service, fourth in inland ports, third in truck cargo. So it's very, very much, a lot of blue collar type of jobs. And that's what we like about Memphis, and we can find these units at a very attractive price for investors. But also, what is also very interesting to know is that Memphis is a rather large city. The market statistical area is 1.3 million residents, and so you have, with the diversity of people living there, the diversity of the jobs in the distribution space, but also, again, blue collar jobs rather. And also you have many Fortune 500 companies who have their headquarters there. So it's not only distribution, there's also other aspects, including healthcare is very key part of a Memphis job market. We inserted a little chart here related, showing the increase of rent. So it's data is coming from Berkadia, the Berkshire Hathaway real estate company, and it's showing that you have increasing average rents in Memphis over the past few years, and you have also increasing occupancy. So that's why it's a market we like, and as Mark said, it's the fifth property we have there, and it's a great market. We love it. Finally, on the next page, you have a little point on new jobs being created. So it's not super well known for a lot of growth, but it's very stable. Very stable marketplace, or very stable in terms of jobs, but you still see there's some activity there and people are developing, such as St. Jude's Hospital. They are making a huge investment. Nike just did a huge investment as well, and interestingly enough, Elvis Presley Enterprises are investing, and that's on the other side, on the west side of the airport, and the property being on the east side. So that's all for the market of Memphis. So I think we can open Q&A now, and to kick off the discussions, I will answer a few questions that we received via email. And then we'll let you ask your own questions. And, okay, so first question is, is the deal structured via an LLC as a legal entity? And the answer is yes. It's an LLC that is based in Texas. Next question we have received is, when do you anticipate for the first distribution to be made? And we anticipate that distribution to be made 3 months after closing. Also, next question is, what does the competition look like nearby? Is there any new properties being constructed? And the answer is no. There are a few properties, but I think it's probably the most appealing property in that neighborhood.
I just wanted to highlight one more thing. Mark asked me before about the cash flow streams with or without the pilot. And in running a scenario where we actually distribute all the cash flows that truly come from the pilot savings, the cash on cash ends up being a full percentage point higher. So we had 11.5 in there. That's with the discount that we were putting into the model. But if you were to really run it with all the savings from the pilot, the cash on cash is about a full percentage point higher. So Mark asked me to comment on that. I just wanted to finish the loop on that and share that one as well. We also have questions in here from Daniel. Please describe the investor sponsor distribution plan. I'm not sure if I understand that. What do you mean by the distribution plan?
I think it may be the split. I'm not exactly
Okay.
sure either, but if you can also go off mute if you want to. But the split's a 80-20 split. So 80% to the investors and 20 to the managers. There's a 2% acquisition fee one time, and there's a 1.5% asset management fee. So hopefully that's what you were asking. If not, more than happy to address any other questions.
And there is not a capital transaction fee.
People were asking the minimum investment. Right now it's set at $100,000 for minimum investment. I'm just reading these off of the chat, by the way, so maybe going a little out of order here, but let's go ahead. Exit cap rate was, I think, at 8.3%, which is it's actually a full point above the current market cap rate for that submarket. So we raised it a full point from there. Someone asked, is it an assumption? No, it is not an assumption. It's new debt. Let's see. Close date. Philippe, what's the current close date based on the most current information from the lender?
Oh, our goal is to close mid-April.
Yeah. Let's see. I want to make sure I get these.
Yeah, I received some things privately. I don't know. Is there Section 8 or is it accepted actually, Section 8? I believe yes, but there is currently no current tenant that is Section 8.
Yeah, so he's saying there are no current Section 8 tenants there.
Correct.
Are we accepting 1031 exchange? So I would just make a general comment on that. It is a lot more challenging when you do group buying if there are a number of people in the deal versus doing it by yourself for 1031. So there's some changes required on the legal documents, and then also when you sell the property. So generally speaking, I would say probably don't count on it, unfortunately, for 1031, just because of some of the complexities. If you've looked at it in detail before, maybe you have, there are definitely some complexities when you're doing a deal that's being syndicated. So not saying it's impossible, just saying it's definitely a lot more challenging. Current owners are selling. It's a question. So are the current owners selling the property? The value add play. Why are they selling? So it's a value add play, meaning we know there's room to push rents. There's very little value add from a rehab perspective, right? Because it's already been fully rehabbed. I think they're really selling because they dumped the money into it. They're recognizing they're going to take their money and do another deal. The guy that owns the property, owns tons of properties in the area. He's actually a property manager in the area. So I think it's one of those things. They probably met their business model, and now they're selling to capture their gain. What was the vacancy rate during the recession? I remember, Drew, if you had it, you had a chart at one point in time. We had it. I don't remember exactly. We can get you an answer on that, but it was. Do you know, Drew?
I don't know the vacancy rates of the recession. I do know one of the things that attracts me about investing in this asset class is that it is relatively recession resistant, because if people run into hard times, people in Class B might move down to Class C, and so it is not a strong concern of mine about vacancy on this property. Also because it's sort of defensively priced as compared to its peers in the area. But we don't have specific data on the occupancy on this property, say 6, 7, 8 years ago, to answer that question.
Are you allowing self-Ks? I don't know if you're talking about self-directed, like 401ks, IRAs. I wasn't sure on that question. So maybe if you want to chat on that one. Quite a bit of crime in the area. How do you plan to work with the property manager to reduce on-property crime?
Actually, our investigation, rather, questioning of people is showing that on the property there's no crime. Actually, they had a courtesy officer, so in other terms, a property guard on site, but actually they let him go because the crime was inexistent on the property. And a second facet of this is they're in touch. The property management is in touch with the police, and they get regularly. The police drive around the property, like every other day or things like that. And finally, we had an interesting comment from one of the property managers we consider. He said, the tenant base, is not your typical, necessarily tenant base of Memphis, and the diversity of the tenant base was such that resulted in a low crime. So that was a very, very interesting. It's a mix of minorities, various minorities, and that helps mitigate crime issues.
Yeah, and we're not required to put together, if you're familiar with a crime mitigation plan, which a lot of lenders will require, we're not required to put together for this particular property, which is an indication that the crime on the property is not an issue. Another question on 1031. So, I would say probably need to speak to a CPA, but yes, the related to the 95% of the proceeds going into the new asset, that's where you run into the issue in some cases, where if you have a bunch of people on a deal trying to do 1031, chances of everyone trying to move their money over into a new deal at some point in time is challenging when you're doing a syndicated deal. Let me see. I'm just scrolling down here, by the way. I'm trying to scroll down.
Yeah, it's more of a C-class type property.
Yeah.
See this question.
What other groups buying in Memphis? Memphis is actually becoming a fairly attractive market right now. A lot of deals coming out and a lot of people going there looking for deals. So we've seen even in the last 6 months a pretty high increase in activity of potential buyers in the market. We saw, so it's not a Dallas, where I live in Dallas, but there are a lot of things about Memphis I like much better than Dallas. But anyways, there are a number of groups buying, and Memphis is really, especially with a pilot program in place too, where people are coming in and dumping large amounts of money to really improve the area. It's, that will really make a huge difference. Economic occupancy now, I think probably economic vacancy probably is what is probably meant by that. Drew, I think you have that on the other sheet, but if you want to maybe look at the current T12 economic vacancy, please.
I do. So the current economic vacancy, and this is not just accounting for like delinquent tenants, but as I said before, when you have rents that are market rate is $475, but you have $430 on a one bedroom, that $45 we consider that kind of economic vacancy or economic loss. So when you include those in your accounting of the economic vacancy, it's currently at 14%. So that's concessions, loss to lease, and bad debt all put together.
And vacancy, yeah.
Yeah.
IRA funds, an option? Yes, they are. Is a complex in a flood zone? No.
Nope.
I'm aware of there's no flood zone issues there. Okay, yeah. So thank you for clarifying the question around. Yes, someone was asking about taking like a solo 401k or self-directed retirement account. Yes, that is allowed. Let's see what other questions. Is there a call on the first mortgage in the next few years? No, we're going to go right to permanent financing with agency financing, so we'll get long term on that. Someone asked about the interest rate, 4.48. Yes, as of even yesterday, rates right now are closer to 4.9 to 5%, but we've already been quoted 4.48 even as recent as yesterday, and it's because of a relationship we have with the lender. So even if it does take up from there, which don't anticipate it will, even if it went to 5%, we've already underwritten for that as well. And it makes a slight change, but it's a very, very small change overall for it. What cap rate are we using for the exit? We're using an 8.3 cap rate. So current market cap rate 7.3. We're using an exit of 8.3. The vacancy rate, did we assume for the model? I think you have that in the presentation farther down, Drew, correct?
Say it again.
Our vacancy assumption for the model.
5%.
Yeah. Well, that's just physical, but total.
The total is 14, so 5 and 9.
Yeah. Someone's asking the minimum. Why is it 100,000? Just we think it's going to fill up fast, frankly, and it's as any deal, it's easier to work with less investors. Frankly, it really is. So, if you have an interest in it and the hundreds in issue, let's discuss that for sure.
Corey asked if the first mortgage is assumable. The answer is yes. And one thing that's possibly attractive about that is, as we've seen, rates have moved up a lot in the last 2 months. The Fed is expecting to raise rates 4 times this year. And so if people are out going to look for first mortgage debt in 5 years, they may be looking at 6.5, 6.75. If they're able to assume this at 4.5, that is substantial value add that we can pass along to potential buyers. So yes, it is assumable, and yes, we think that's a very valuable thing, possibly for selling the asset down the road.
Yeah. Do we foresee a refi? Potentially, but I would probably think more of a sale. It could end up being a refi. It'd probably be later in the part, 4 or 5 years out into it. But especially if we can get these rents up, they're already $45 below right now. They're already renting at that. And we projected $70 over a 3-year period. So if we can get our revenue up to where we think we probably could, then it might totally make sense to do a refi. But as of right now, we did not model it with a refi.
Adam asked if we took the exit cap rate into account, if we took into account the significant property tax rates that will be occurring, and the answer is yes. That was we spent a long time analyzing this from a dozen or 2 dozen different angles, but we definitely hit the NOI hard on our exit sale, knowing that if any buyer was to buy this in 5 years, when there were 2.5 years left on the pilot, they would significantly discount the NOI to reflect that pilot program expiring. So we absolutely took that into account and looked at it very carefully.
And that's one of the reasons we underwrote it as well, showing the increase in property taxes, even though we will have that cash flow. Price per door seems low, considering rehab is complete. Market interest is increasing. Comments, thoughts on why? For one, I think we're frankly getting a good deal on it, without a doubt. And I think the current owner is making a good amount based on the rehab they've done. It was the current owner actually has his own crew for construction, so his costs were much lower. And other than that, it's they dumped $12,000 a door into the property, and I frankly just think we're getting a good deal on it. Entity structure, can we explain it more? This will all be in the documents as well, but other than the 80-20 split, you're going to have Class A memberships with investors. Managers would be Class B. 2% one-time acquisition and 1.5% asset management fee based on revenue collected. I'm not sure if there's anything else on that particular structure, but that will all be detailed out for sure in all the legal documents as well. But more than happy to answer any directed questions. But that's essentially the entity structure. I mean, it's going to be an LLC for the property. If there's more you're looking for there, we definitely can answer it. So for a $100,000 investment, the annual return is $11,000 per investor. Yes. Pretty long question. Okay, so yeah, that's yeah. If someone does have something else that question was directed towards me directly around a certain person's situation, so I'm not gonna read that one. I'm just scrolling down here, see if we missed any so far. What about the property management performance experience makes them exceptional? If you know the Memphis market and speak with anyone, like from a broker perspective or a lender perspective, David Shore's name will come up 99% of the time, maybe 100, I don't know. They're the go-to company there. They own a lot of properties there. They've been there a long time. You know, are they perfect? No property management company is perfect, but I can tell you without a doubt, their name comes up being recommended by everybody in the market, without a doubt. Payout schedule, dispersed cash would be paid out on a quarterly basis. There is no preferred return on this deal. Is there an offering memorandum to review after this call? Yes, we have I think you're asking for the broker's offering memorandum. More than happy to share that as well. When will subscription documents be available? I would say probably the latest Monday. That still hold true, Drew? You think for the PPM and such?
Yeah, I think it might be available tomorrow.
Friday. Yeah. So latest Monday, should be sooner. They're prepared, been drafted, everything else.
Yeah.
And we've actually reviewed them and provided comments already. If an investor needed cash out in years down the road, can the invested amount be sold to another investor so the original investor can get their cash out? It's not transferable, but with management discretion, we can decide. I would say this, I would go into the deal assuming, no, you can't get it out. You know, so you need to go into it thinking that, my opinion. Is there a provision for you to get it out? The answer is yes, but that's based on management discretion. So. What's the debt coverage ratio on the property? I don't know if you're asking currently or not. What's the current debt coverage, Drew? You remember?
In year one, it's 1.6.
Yeah, and that's why we're getting very favorable financing. So if you're not familiar with that term, it's basically just, you know, how much is the NOI greater than the debt payment? You know, what's your mortgage? So a stabilized property that's fairly attractive is considered 1.25. So the higher the number, the better it is, and we're at 1.6 in year one. So that's extremely good. After the call, what are the timelines for the next steps? Really, the next steps would be we'd be sending out the subscription agreement, basically all the legal documents we'll be sending out. I say the latest Monday. I think there'll be before that, but just have that kind of in your head. The latest will go out is Monday, and they'll go out with all the legalese for you to review. Do you have?
We will be sending out an email to everyone through the Nighthawk Equity portal, and that will direct everyone to find this presentation that I went through and the recording, and it will also have a lot of these documentation. So next steps will be to receive that email and click through it to the Nighthawk Equity website and review the documents yourself and then express interest through there.
Right. Next question, which is the last one as of now, is do you have local troops on the ground? We don't have anyone that lives there locally. We do have someone on the team that goes there on a frequent basis because now this would be our 5th property. So he's there physically at least once a month. So but nobody physically living there on the team, just going there and checking up on it. Someone mentioned, tough question. Any thoughts on how the property will perform in a downturn? My personal perspective, just my perspective, I think it'll perform well in downturn, somewhat to Drew's point that this type of property is attractive even in a downturn because people will move down from one asset class down to another. And I just think from the demographics and the tenant base, it'll do good in a thriving market. It'll do well in a downturn as well. The rents are still low, relatively low, even with the bump, and they're nice, clean, functional, safe property with it's gated and things like that. So I think it'll do well in even a downturn. And if we missed any questions, because I got down to the bottom, so I apologize. There were, I don't know how many, maybe 50 questions, 60, 50 questions came in there. If there's a question we didn't cover, even if you put it in there, we missed it, please go ahead and put in the comments and we'll address it. I don't see any more coming in, so that probably means, okay, there's one coming in. People probably think of it after the fact too, but so how are the other properties, Memphis properties, that you own tracking in relation to your pro formas? So they're relatively newer. They've been less than a year. All 3 properties are doing very well. In fact, the most recent purchase was at the end of December, and the same property management company running that property is going to run Dogwood. And most people know during January that's a very tough time to lease up. This particular property is 321 units. It had about 80 units that were vacant, being rehabbed, and somewhat minor rehab. And in January, the management company leased 35 of those units in January, which again is one of the toughest leasing seasons. So they're doing well. But in fairness, I would say it's newer as well. But so far, we've been very happy with the performance on the properties. And I believe that was the last question. So if nothing else comes in and people get off and think of all these questions, but that was very, very good. I think those questions were really, really good. It helped. I'm sure it was beneficial for everyone to hear the answers to those. If there's something you think we missed, or like I said, you come up with a question after the fact, just let us know. There actually was one other question came in. You mentioned some conservatism in your underwriting. However, you noted that you will utilize your existing property management company. Is it there additional conservatism related to your management fees and payroll? I'm sure I exactly understand the question. I'll make one point and see if it addresses it. The property management company now is running it pretty effectively. You have to keep in mind that they've dumped in $1 million or $12,000 a door over the last couple of years. So now it's kind of like they're really at the point now where they're getting those higher rents. The repair and maintenance budget has gone down drastically because of all the rehab. So I'm not sure if that totally answers the question. If not, I'm more than happy to answer it. Cool. I think that answered it.
Yeah, I think just in conclusion, look for an email coming out from Nighthawk Equity to you with a link to get onto our portal and learn more about the asset. You can, again, review the presentation and this video if you'd like to, and then sort of indicate your interest from that point. And you can also ask us further questions there as well. So thank you, everyone, for your time. And That's it.
Yeah, thanks, guys. Really appreciate it.
Thank you, everyone.
Take care.
Good night.
Thank you all.
Thanks.